All right, we're now up to lesson 8 in this financial accounting series, liabilities and present value. Before we dig into details on this one, we just want to look at a couple examples so that we can see how liabilities are going to be different based on company, based on industry. And I have side-by-side examples here for Walgreens and Boeing. For Walgreens, we can see that one of their biggest two liabilities is operating lease obligations, and then the other one is trade accounts payable. Operating lease obligations, this is basically leasing space for their stores. So when you think of all the Walgreens that we see in strip malls and such, so that is lease payments that there are in lease obligations that they have to the owners of those malls. And when I say lease payments, it is more the obligations in the longer term contracts that they've locked into. And then trade accounts payable, our second biggest liability, it is effectively what they owe to their suppliers for all of the pharmaceuticals and the other products in their store. Boeing, their biggest liability is advances in progress billing, and the second one is long term debt. So advances in progress billings, this is a more rare account for companies to have, especially in this size. I don't know if anyone, my guess is Boeing probably has more of this than anyone in the world. At 56 billion. But what that is customers who are paying as they go as Boeing is building the airplane for these customers. So Boeing does not just build the whole airplane and then have the customer pay at the end. The customer has to pay as they go. But if we think back all the way to lesson 3, because Boeing hasn't actually delivered an airplane yet, when they get cash, they actually debit cash and then they credit an unearned revenue. This is like an unearned revenue account right there. And then when they deliver the airplanes, then they reduce this liability. And then long-term debt. I mean, Boeing is, they have a ton of fixed assets that they have to support, that they have to finance somehow. And frankly, they've also had struggles. So it's not like their operating cash flow has been so huge to finance everything that they need. So their long-term debt has been an important thing for them. Well, the overview, we're going to determine how to account for liabilities. This chapter, when I think about it, this lesson it's liabilities, and we're preparing with some present value concepts, future value concepts, because we're going to get into bonds in the next lesson. So we're going to talk about future value of a single amount and an annuity, and present value of a single amount and annuity. So this lesson kind of has two distinct concepts going on in it. Well, determining how to account for liabilities, we're just going to take a look at a ton of liabilities here. So current versus long-term liabilities. Current are those that are expected to be paid with current assets. All right, so they are expected to be paid off within 1 year. Most creditors expect to be paid off with 1 year, and thus the majority of the types of liabilities that we are going to see, they are current, right? So we look at some of the examples that we just saw for Boeing and that we just saw for Walgreens, and long-term debt. Banks have maybe made long-term loans. Sometimes bonds payable are long-term, and then lease obligations for Walgreens if they have signed into a multi-year contract. Those are going to be long-term liabilities. But a lot of your main ones, accounts payable, suppliers want to get paid, wages payable, employees want to get paid, income taxes payable, the government wants to be paid, unearned revenue, people want their goods or services. All right. And those are some of the exceptions we talked about. Pension liabilities for their retirees, and then deferred taxes, which is a concept way too complex for this financial accounting overview. That would be more advanced financial accounting. So accounts payable, we've talked about this before. So some of this lesson is going to be review with items that we've hit before, and some of it will be new. So these are items that were purchased but not paid for right away with cash. So they were purchased on account. So just think of like inventory as a classic one, right? So Walgreens got some inventory, and they promised to pay back their supplier. They debited inventory. They credited accounts payable. Again, accounts payable often going to be paid off within about 30 days. I'm just going to put that out there as an estimate. There's no interest on it. It's not like there's a set repayment date. Usually your schedule is like just pay us off within 30 days. That'd be the most typical kind. And it differs from a note payable. And again, accounts payable are in the ordinary course of their business. It differs from a note payable, which is going to be more like you're borrowing cash, more of an isolated transaction. You're going to have a set repayment schedule with a set interest rate. All right. Most often, yeah, I mentioned inventories, but supplies and other services as well. So Walgreens purchasing medicine from Johnson and Johnson, right? And maybe they're going to make payment next month on that. Debit inventory, credit accounts payable. That would be the journal entry. Now, when they actually go ahead and make payment on that one, that's when they get rid of the accounts payable by subtracting off that liability and crediting cash. So that's your classic accounts payable life cycle. And accounts payable are material for most companies. A lot of businesses just extend, roughly 30 days, sometimes up to 60 days to pay. Well, accrued expenses and liabilities, there is a whole slew of them. These are recorded when a company receives services or supplies by the end of a period but does not pay for them until the next fiscal period. Oftentimes, there's going to be an estimate for a bill that has not yet been received. I did consulting work for a long time when I was a professor, and they would even, at the end of the year, when they're trying to make sure they get all their accruals in place, they would have to ask me, like, what amount, Boz, of work have you done for us that you haven't sent us a bill yet? Maybe that you're going to send us a bill, for your December time in January. So they would have to set up an accrued liability payable to Boz. Because the goal is to match expense with the financial statement income. You're recording the expense in the period when the activity occurred to cause that expense. So if Walgreens has an electric bill for the month of September, but the bill won't be received until mid-October, the adjusting entry in September is you would debit utilities expense and credit utilities payable, and then when you ultimately paid it off, you would debit utilities payable and then credit cash. And again, that first entry there, the adjusting entry, that one would actually happen in September. At the end of September, you would make that entry to match the expense in the period that it relates to. The next one here, income taxes payable. And income taxes payable is tax expense that's recorded when a company earns income and not when cash is paid to the government. So if a company earned money in one year and made all of its payments in that same year to the government, you might not need an income taxes payable account. But this especially happens that a company will earn money in a given quarter or a given year and not actually make payment until the next quarter or the next year. So we want to set up an income tax expense that associates with the income in the period that we earned that income. So let's say that Walgreens earned pre-tax income of $2 billion for its year ended August 31st, 2021. So again, Walgreens uses an October 31st year end, and they accrued tax at a 33% tax rate. The adjusting journal entry for this expense, and this would be the adjusting journal entry that would happen in August, would be income tax expense and then income taxes payable. And then the journal entry for the payment, whenever that happened, whether that was September or any time later, income taxes payable and cash. So we don't wait until we make payment on this one. We instead record the expense in the period when we earned the income. Compensation. Companies record compensation expense in the period in which it was earned by the employees. All right, so the company incurs it. It was earned by the employees. Now, let's say that a worker earns $200 per day, and on December 31st, they haven't been paid for 5 days of work. Also assume that the worker has earned but has not been paid for 2 days of vacation and a $150 bonus. So, we owe them for some days worked, we owe them for some vacation days, we owe them a bonus. So we would do an adjusting entry here in December to accrue those expenses: wages expense, bonus expense, and vacation expense. But we haven't paid them yet, so we would credit some sort of wages and benefits payable type of account there. The benefits would be, as an example, like the vacation expense that way. So $200 a day, 5 days of wages. We got the bonus of 150, and then vacation expense $200 a day times 2 days. The journal entry for the payment, then we would get rid of that payable, the debit to the wages and benefits payable, and then credit the cash. Payroll taxes. So employees have certain deductions that are withheld from their paychecks, and payroll taxes is one of those. Social Security taxes, 6.2% on the first roughly 160 grand of wages, and then Medicare taxes, 1.45% on their total wages. And that Social Security tax, when it's applied on 160 grand, that 160 grand goes up pretty rapidly every year. It's a lot more than inflation. It's just another source of revenue for the government in addition to income taxes. So they also withhold federal and state income taxes. The employer must match the payroll tax amounts. The employer must match payroll tax amounts, but not the federal and state income taxes withheld. There will also be withholdings from employees, oftentimes for other benefits they might receive, like health insurance, maybe retirement savings, take it right out of their check and put it into a retirement account for them, and many others. So an example here, let's say that an employee earns $1,000. The employer withholds payroll taxes, $100 of federal income taxes, $50 of state income taxes, and $85 of health insurance premium. So this is maybe for a 2-week period, as an example. Well, their gross wages are $1,000. The Social Security taxes are $62. That $62 isn't above, but what that is that's 6.2% of the wages. The Medicare taxes are not listed above, but those are 1.45% of the wages. Federal income taxes, state income taxes, health insurance premium. So the employee is actually going to get paid in their take-home pay $688.50. Now the journal entries behind this one, so that's what the employee is going to get paid. On the previous slide, you may mention, and we said that the employer has to match payroll taxes. So we're going to see that the 62 and the 1450 are going to get matched by the employer. Nothing else is going to get matched, legally. They might kick in for some health insurance from the employer standpoint. They probably do, but that's going to be a separate issue. So the journal entries, we've got the wage expense of $1,000. But then we don't credit cash for $1,000 because we withheld payroll taxes from the employee and we got to pay them over. We withheld income taxes and we got to pay them over. We withheld health insurance and we got to pay that to the health insurance company. So we actually give the employee $688.50. Now the employer has to match the payroll taxes. So they debit a payroll tax expense and credit payroll taxes payable. All right, so that's the employer side. So payroll taxes get paid twice, basically, once from the employee and once from the employer. It's a little side note, but if you're self-employed, you have to pay both of those yourself. That's more of a tax concept. Now, the journal entries there, when they go to make payment, the payroll taxes, that liability is going to be debited. Income taxes liability is going to be debited. Health insurance is going to be debited. Payroll taxes payable are going to be debited, and then the credit is cash of $388. Now, the company's total expense related to this employee is the $1,000 of wages that they earned and the $76.50 of the payroll taxes that the employer had to match. So that's their total expense. And then their total cash payments are going to be that same amount. They don't happen at the same time. The $688.50 is what gets paid to the employee, and then the $388 gets remitted to the various governmental agencies and the insurance company, but the total of the cash payment is going to be the same as the expense. But we want to record these these liabilities and the payroll tax expense in the period when they are incurred, when the employee works. Unearned and revenues, sometimes called deferred revenues. We covered that one in lesson 3. But when a company receives cash before it delivers goods or provides services, it must set up a temporary liability account. they have an obligation to deliver goods or services. And if they don't, people are going to come looking for them for those goods or services or to get their money back, right? So let's say Boeing receives $100 million from Delta Airlines for a 737 plane. The journal entry when they receive that payment, debit to cash and credit to unearned revenues. I think when we, saw what Boeing actually did, it was something like advanced billings was what they called that liability, but it basically meant the same thing as unearned revenues. When Boeing actually delivers the plane, then they're going to get rid of that liability by debiting it, and then they're going to credit revenues. So we don't credit revenues, solely, when we get the cash because we haven't delivered the products yet. Accrued warranties. Many companies offer warranties on products that they sell. If the product is defective, the company will fix or replace it. So companies will need to record their estimated warranty expense at the time of the sale and not when the claim is made. This is very similar to a bad debt expense. Like if you know that some of your accounts receivable you're never going to collect, if just history shows that, you got to estimate bad debt expense in the period usually when you make the sale, right? Or evaluate accounts receivable each period. Same thing with warranties. If you know that you're going to have some warranty costs, you want to record those at the time of the sale. So let's say that Toyota provides a limited warranty whenever it sells a vehicle. Each time it sells a Camry, it estimates a warranty cost of $800, and it may then pay amounts to dealerships who are actually going to provide those warranty services. So Toyota corporate does that. The journal entry to recognize that expense is the debit the warranty expense, credit accrued warranties, and then if someone who owns Toyota takes the car into an independently owned Toyota dealership who does the work on that car, then Toyota corporate at that point in time will get rid of their warranty liability and then credit cash. But we don't wait until the cash payment is made to record that full warranty expense. We try to estimate it and record it in the period of the sale. If there's evidence that there's going to be those amounts. Short-term debt, new concept here, short-term debt, and the current portion of long-term debt. So companies frequently borrow funds with payment dates that are more than a year away. Initially, they're going to record a long-term note payable or a long-term debt, one of those types of liabilities on their balance sheet. When the amount becomes due in 1 year or less, so again, not when they're paying it off, but when it becomes due within 1 year or less, they're going to reclassify the amount as current. So let's say on January 1st, Walgreens borrows $2 million on an 18-month loan to construct a new store. Well, the journal entry at the time of the borrowing is going to be cash and long-term debt because at that time they're not going to pay it off for 18 months. But then when they get to the end of the year, now that debt is going to be paid off within 6 months. So we want to show that it's a current liability. So we debit long-term debt and we credit current portion of long-term debt. The main thing there is because we show that it's a current liability, investors and creditors will include that when they're looking at how many liabilities that a company has to pay off within the next year. And if a company, and that's going to be a ratio that we get into in lesson 12, but if a company has a lot of current liabilities and doesn't have a lot of current assets, it could be an issue whether or not that company is going to go bankrupt. So that's why we want to properly reclassify that as current debt. Leases of fixed assets. Accounting depends on the term of the lease and other factors that way. Short-term leases are classified as operating leases. We record the expense each year. Long-term leases are classified as capital leases, and they're accounted for as a lease asset, and there's also going to be some sort of corresponding lease liability. We saw in CVS's liability section all of those long-term lease liabilities that they had. And that was a huge liability on their balance sheet. And leases are a pretty complex issue, and you would learn more about that in some sort of intermediate accounting course. Contingent liabilities. Companies can face lawsuits, and the question is, well, when do you record the expense or payments related to the lawsuit? If someone just says, hey, I'm going to sue you, do you record an expense at that point in time? Well, you need to look into what the likelihood is that you're going to have to make a payment, and then can you estimate the amount of the payment? If it's probable, you're going to have to make a payment and you can estimate it. Yeah, then you got to record the expense on your financial statements. If it's likely, but you can't estimate it, you disclose it in the footnotes. All right. And what that really means is that uh, you put it in your financial statements, but you don't know what amount it is. So it's not like you can put it on your financial statements. You just don't know the amount. And if the payment is reasonably possible, then you will disclose it in the footnotes as well, okay, whether or not you can disclose it. But if the chance of payment is remote, you don't record it or disclose it anywhere. So this is a real case here. Walmart, they paid bribes to government officials in Mexico to help them generate business. They basically did that to get permits more quickly than they were supposed to, and then also permits in areas where they were not supposed to. This was a big foreign bribery case. I speak a lot on ethics, and that was one of the biggest ethical cases I've covered over the last decade. This is illegal. It's a violation of the Foreign Corrupt Practices Act. They're subject to fines. For many years, they were aware of this investigation, but they couldn't estimate the amount of the fine, so they just kept disclosing it in their financial statement footnotes. But in 2018 financials, Walmart then understood that it was going to have to pay about $283 million, and maybe that wasn't exact, but it was a pretty close estimate. So then at that point in time, then they recorded an expense in their financial statements, and even before it paid the amount in 2019. So in 2018, they debited the expense, they credited a payable, fines and penalties, something like that. And then when they actually made payment in 2019, they debited the fines and payable liability and they credited cash. Additional long-term liabilities, deferred income taxes, an advanced concept. They're going to be recorded in order to match income tax expense against financial statement income. A lot of complexities with that one. Pension liabilities. A company may promise to pay a former or retired employee a set amount per month or year for the rest of their lives. And they would set up that can be an enormous liability for companies. Companies used to do that all the time. They would say, okay, if you work for us for 20 years or whatever the number is, we're going to pay you a portion of your salary for the rest of your life. That became an enormous cost for companies, so a lot of companies have gotten away from doing that. And instead, companies will make contributions to an employee's retirement account. And sometimes they'll actually not only give them a cash payment, but also health insurance benefits as well. Big details covered in intermediate courses. Notes payable. We've covered this one before, but we'll look at it a tick more here. So a company might borrow cash from the bank to fund operating needs, capital investments, acquisitions, expansions, for whatever reason, right? And then notes are formal written agreements. So when we say notes payable, it's usually some sort of legal contract at that point in time. There's a repayment schedule, there's dates and interest rates and a bunch of other terms. So when a company borrows, they're going to debit cash and credit a notes payable when they actually borrow the money. Now, to compute interest expense, you're going to do P times R times T, principal, so the amount of the loan, times the rate, the interest rate, times T, which is time. Now, I intentionally bolded and italicized these because these can be very tricky on people. Principal is easy. Just what did you borrow? The rate, the R, is always an annual interest rate. So if you see an interest rate, it should be quoted as an annual rate, whether or not the loan is outstanding for 1 year, 1 day, 1 week, 1 month, 10 years. Rates are quoted annually. And then the time is not how long the note is, it's how long the note was outstanding during this accounting period. So oftentimes we just do that in months. In this example, how many months was this note outstanding for during this accounting period? And we'll divide that by 12 to figure out interest expense. So let's say on March 31st, 2024, a company borrowed 10 grand at a 10% interest rate. Principal is due 6 months later. All right, well, they debited cash and credited notes payable at the time of the borrowing. They don't factor in the interest rate. They don't factor in the time at this point in time. They just record the 10 grand. Now on September 30th, they pay off the note payable. And there's also some interest expense. the 10 grand, and then it's a 10% annual interest rate, but it's not like you pay the full annual interest rate here because the loan was only outstanding for 6 months. So you pay 6/12 of it. All right. And then you credit cash for the 10,500. Well, it becomes more complex here when, in this example, they borrowed on March 31st of 2024. They're going to repay on March 31st, 2025. The first part is easy. It's the same example that we just went through. All right. But now what happens when you get to December 31st, you don't have to pay any interest yet, but there is some interest that you will have to pay because this note has been outstanding for 9 months. All right. So because this note has been outstanding, even though payment is not yet due, there is going to be payment that's necessary. So we want to record the interest expense that has accrued so far. The interest expense that is going to have to be paid because of the borrowing during this period. So we would take the 10 grand, multiply it by 10%, and then multiply it by 9/12 to get $750 of interest expense. And then, but we don't pay it, so the credit is to interest payable. Now we go to the next year when we're going to pay this off on March 31st. The only simple part is that you probably understand the note payable goes away. Now the interest payable goes away, but there's more interest expense because the note has been out there for 3 more months. So it's 10 grand times a 10% annual interest rate times it's been outstanding for 3 months during that year. And then the cash payment is going to be that full $11,000. So that's a complex concept right there. I just kind of cover it. You might have to go back and rewind it or consult it at another point in time. But you put the interest in the period when the loan is outstanding. You don't just do all the interest expense in 2025 when it's paid. Well, a review question here. Let's say that let's say that an employee works 8 hours at a rate of $20 an hour. When factoring in payroll taxes, what'll be the company's total expense? All right. An employee works 8 hours, $20 an hour. So can you figure this one out? Well, it's not $12.24. That's going to be the payroll taxes that both the employee and the employer have to pay. It's not going to just be the $160 because the employee, oops, I bumped something. Just a sec here. Back here, I bumped something that wasn't advancing. It's not just going to be the $160 because payroll taxes are on top of that. It's not going to be the $184 because payroll taxes are effectively paid twice, but the employee is going to pay one part of those. It's going to be the $172.24. The employer owes the employee $160, and then they also have their share of the payroll taxes, which is 7.65% of the $160, the 6.2% Social Security, and the 1.45% Medicare. Another review question. Let's say a company borrows $5,000 on November 30th. The interest rate is 12% and payment is due on March 31st of the following year. What is their interest expense in that second year? All right, so as you think about that one, pause the video if you want to test it or just watch my solution. It's not just the $50. That would be the interest expense in 2024 because that $5,000 loan at 12% is outstanding for 1 month, the month of December. It's not $200. That's going to be the total interest payment in cash in 2025. All right, the $5,000 times 12% times 4 months. It's not $600. That'd be the total interest if the loan was outstanding for 12 months. It's not. It's only outstanding for 4 months. So the answer is the $150. So in 2025, they're going to record 3 months of the interest. $5,000 times 12% times 3/12. All right, 50 of the interest is recorded because in 2024 because the loan was outstanding for 1 month then. 3 months in 2025. Total payment will be $200 in 2025. All right, so we beat through a lot of liabilities there. The other stuff that we're going to go through is computing the future value of a single amount and then also future value of an annuity. Now, the concepts here is that many transactions involve paying or receiving money in the future, And as a company can earn interest on its investments, the general theory is that a dollar today is worth more than a dollar in the future. You'd rather have a dollar today than a dollar a year from now, because if nothing else, you could just earn interest on it. All right. And even if, let's just say, you could earn a 1% interest rate, you'd rather have $100 today than $100 a year from now, because you could just invest it at 1%, and at least then you'd have $101 a year from now, right? So you'd rather have money today because you can earn interest. At the same time, a company would rather pay $100 a year from now than pay $100 today. Why is that? Because let's say you had to pay $100 today. Well, you just got to go get $100 today, right? But if you didn't have to pay $100 for a year, maybe you just go find $99 today, and then invest it. And then that becomes worth $100 in a year, depending upon the interest rate. And then you pay it you pay it in the year. So the concept of interest means that amounts today are worth less than the amounts. The same amount today is worth more than an amount in the future when you're going to invest it, and when you're going to pay it, an amount to be paid in the future. The value of that payment today is going to be less. I just went through that example, not that $99. The future value of a dollar. So the current amount times a factor is the future value. So if a first-year college student invests $1,000 today, how much will they have when they retire in 50 years? And assume that the investment earns a 10% interest rate. Now, there's actually math formulas you could do. You could use financial calculator. Real world, you'd use Microsoft Excel. But here, going to use just a present value chart for this one. And I'm going to look up 50 periods at a 10% rate. And the factor I find is 117.3909. What we would then do, again, that's 50 periods at 10%. We would take the $1,000 invested today, multiply it by 117.3909, the factor, and we would say that would grow to 117 grand in the future. All right, so your future balance is 117 grand. You only invested $1,000 today. Interest earned on that is 116,000. So that's why you want to start investing young. You set aside $1,000 today. 50 years from now, it's going to be worth a lot more. Now, granted, inflation, goods and services are going to cost you more in the future, but with any luck, you invest at a higher rate than inflation, so you still end up with more money. Future value of an annuity. So an annuity, when you hear an annuity, that's a series of equal payments. All right. An annuity amount times a factor is the future value of an annuity. So let's say a first-year college student invests $1,000 today, and then again at the beginning of each of the next 49 years. So they make 50 investments in total. How much will they have when they retire in 50 years? And I think a lot of college students could probably do this. $1,000 is not just pocket change, right? But this would be basically be trying to find $20 a week, working on average an extra hour and a half, depending upon, what rate you can make per week, and just socking that away. Would it be worth it to do that? Well, we go to this table right here, which is the future value of an annuity, 10% 50 years, and we see a factor of 1,280. We then take that $1,000 investment that we're making 50 times that factor of 1,280, you would have 1.28 million in 50 years. You'd only invested 50 grand. You'd earned 1.2 million of interest. So yeah, can people do that? I think, absolutely. And people that invest wisely will do things like that. And then a lot of times they'll invest more than that $1,000. But you want to be a millionaire? Set aside $1,000 a year for the next 50 years, make 10%, you can be a millionaire, right? Review question 3. So to try to maximize the future value of investments, an individual should try to invest at which one of these? All right. Well, it's not every year at a low interest rate. It's not one time at a high interest rate. It's not one time at a low interest rate. If you can invest every year at a high interest rate, then you are going to have the maximum amount of value in the future. The final section that we're going to get into is going to be the present value of a single amount and the present value of an annuity. And these items we are going to get into in the next lesson quite a bit when we talk about bonds and having to come up with the value of bonds. But present value of a dollar, the same type of thing, right? Is that if you have to pay an amount in the future, it doesn't cost as much in today's dollars. So you take a future amount multiplied by a factor, and then you get the present value. So if a couple expects to pay 30 grand to purchase a new car in 5 years, they're trying to set aside some money, how much should they set aside today? And assume they can earn 6% interest? Well, they should set aside, and again, this is 5 years and 6%. This table right here, if you look in the upper left-hand corner, it's present value of the dollar. So you go to 5 periods and 6%, and you look for that intersection, and it's 0.7473. So what we're saying is if the couple could set aside just $22,000 today and invest it at 6% for 5 years, they'd have 30 grand 5 years from now and could buy the car. And that's because they would have earned $7,500 of interest. Now, the present value of the annuity, I love illustrating this one by using the Powerball. When I actually pulled this one here in early July of 2024, to figure out the future value of an annuity payment, you take the amount of each annuity payment times a factor, and that's your present value. So let's say you play and win the Powerball, which is generally a very bad financial decision, by the way. So yeah, you're statistically going to lose money. So not endorsing that. You could either receive $19.4 million today, or when it says that estimated jackpot, that's actually paid out over 30 years. And for simplicity, I just divided that $41 million by 30 years to come up with how much you'd get per year. It actually starts where you get less in the first year and then more like in the final year. But so this is a simplistic example to look at this. If you believe an appropriate interest rate is 3%, which option should you choose? The 19.4 million today or the 1.367 million per year for 30 years? Well, we could go to the present value of the dollar and of a $1 annuity, and we could see that 3% for 30 years has a factor of roughly 19.6. What you would then do for the Powerball is you could either get 19.4 million today or 1.367 million for 30 years, and we don't just multiply that by 30. That would be no interest rate, okay? We multiply it by something less than 30 years, the 19.6, and the 26.8 million is what it's worth today. So in theory, you should choose the annuity option. Now, my guess is almost everyone wants the money now. So what you would quite possibly do is you'd set that up with a lawyer, and you'd actually, if you wanted all the money now, you'd set it up with a lawyer and a bank, and you'd maybe sell that Powerball ticket to a financial institution who would buy that from you so that you could get closer to that 19.4 million today. They might not give you all that. I mean, they got to make a profit on that somehow, but that's kind of the theory. You would have an income stream of value that you could sell to someone else. Now, if you believe that the appropriate interest rate is 8%, which option should you choose? Well, 8% over 30 years, that's going to be 11.2578 is going to be that factor. So the Powerball, it's either receiving 19.4 million today or 1.367 million, in which you look at what's happening. If there was no interest, you would just multiply it by 30. And you get back to that 41 million we saw on the Powerball drawing. But the interest rates are higher, so money in the future is worth even less today. All right? So we would multiply it by that 11.2578, and that income stream is only worth 15.39 million today. So you would choose the cash now option. So that's kind of how you use present value of the dollar and present value of the annuity. So the final review question, let's say that an individual will receive 10 grand in 2 years. What is that worth today, assuming a 6% interest rate? And I actually just give you 4 different factors. So you have to figure out which one of those you should use. I went through 4 examples, right? Present value and future value of the dollar and the annuity. So which one do you think you should use? Well, they're going to get 10 grand in 2 years. What is that worth today? It's not worth 11,236. That'd be the future value. if you invested it today. It would not be the 18,334. That would be the present value of a $10,000 annuity to be received at the end of each of the next 2 years. It would not be 21,836. That'd be the future value if we received the 10 grand twice and invested it. It would be 8,900 bucks. If you're going to receive 10 grand in 2 years at a 6% interest rate, the factor is 0.89. It'd be worth 8,900 today. Well, key takeaways on this, a little longer lesson. They've been a half hour so far. This one was 40 minutes, just a lot to cover in this one. Liabilities are recorded when it's probable that a company will need to make payment or provide goods and services. The future value of $1 is worth more than $1 today, and the future value is greater the higher the interest rate. The present value of a future cash flow is less than the amount of the future cash flow, and the present value is lower the higher the interest rate. That's what we got. You made it through. We'll see you for the next one.